Hello, ladies and gentlemen. My name is Greg Michalowski, and I am here today. Today's date is May 29, 2013. Obviously, I'm here today. But as the guest of FX Street, giving here my monthly webinar. Today I'm going to talk about where we've been, where we should be going, or maybe going here. Before we get started, my email address is greg@fxdd.com. If there's any questions or anyone wants a PowerPoint, I'd be happy to send it off to you. Also, my Twitter is GregMikeFX. You're listening, I have live commentary every day at livestream.com/FXDD, and you can also read blog commentary at fxddnow.com. Before we get started, let me remind everybody that trading foreign exchange carries a high level of risk that may not be suitable for all investors. In addition to that, leverage creates additional risk and loss exposure. Before you decide to trade foreign exchange, I'd like you to carefully consider your risk tolerance, your investment objectives, and experience level. You can lose all or part of your trading principle in trading foreign exchange. So what I like to say is be aware and be prepared. So let's get started here. I got about 45 minutes or so to an hour where we can talk a little bit about where we've been and where we should be going. And before we get into that technical aspect of it, or actually we're going to talk a little bit about technicals and fundamentals here today, and I'm going to focus a little bit on some of the major currency pairs that are moving a little bit more, have a little bit more trendy or potentially trendy opportunities. We will get to that in a second. But before we get started, it is what I often find that people say about technical analysis is that it tries to predict the future from the chart patterns of the past. Tries to predict the future from the chart patterns of the past. And I can't help but think of the old sitting in my car and thinking about the past as what I've just gone by, what is behind me, and when you look at technical analysis, and when you compare it to that, or have that visual about looking in, let's say, your mirrors, there are different traders, depending upon your experience level and all, have different visions of what technical analysis can or cannot do. Some people will take a look at technical analysis and look in terms of you're looking through your side view mirror. You're looking at the past through your side view mirror, and you see the trucks behind, you see the road behind, you see the mountains and the lake here behind. You see everything that's behind you and nothing that's in front of you. And that's people who don't subscribe to technical analysis as a tool for your trading will often say, well, it just tells me everything about the past. It doesn't tell me anything about the future and stuff like that. And that's a mistake. But that's one of the visions that some people have on technical analysis. And some people, especially if you're new to technical analysis, can see the storms behind you, but you don't see the road ahead. Even though there's blue skies ahead, and there's a potential trading opportunity ahead, you're looking in your rear view mirror and you see what's behind you, but you don't see the road ahead. You can't vision. You still don't get that idea about what's going on in the white in your charts, the stuff that's ahead. We have all these bars going from the left side of your screen to the right side of your screen, and then we have this white section in front, which is the future. And if you're not adept at technical analysis and what may be ahead, you don't see. You may not see that there's blues, that there, what the road ahead is looking like. You don't see where you're driving, and there may be a truck right in front of you, and you don't know it, and you can go plowing right into it. So that's a vision that other people have with regard to technical analysis. And then there's a lot of people who see the road clearly behind them, but the road ahead of them, they know there's a road ahead of them. They've gotten that far, but that road ahead of them is very blurry. They don't have an understanding of where we're going, or how to use this thing called technical analysis to their advantage. So the road becomes very blurry. The past, what is behind us, is important. But in trading, what lies ahead is how you, as a trader, are going to make money. or lose money in your trading. Okay, and there's no guarantees here that technical analysis is going to be able to show you what or what I say here today in regard to where we've been and where we may be going. This is going to show you the promised land that you're going to make money. You may actually lose money in the trading, but what lies ahead is how you are going to make or lose money in your trading. And there needs to be, for you as a trader, there needs to be a clear vision clear vision as possible in both directions. What's in the past, what's in the future. If you can take a vision of what happened in the past and project the future that's in that white area of your chart that you don't know about, you're gonna be on your way to becoming a better trader. Technical analysis needs to be able to do that for you to be effective. You need to see the past, but you also see, instead of the blurriness of the future, you need to see a future that's a little bit more clearer to you. Now that clarity, don't get me wrong, that clarity doesn't necessarily mean that you're going to be profitable, but you have a clarity, okay? And for me, the technical picture that I look at when I look in my rear view mirror, my side view mirror, the technical picture does three important things. One, it gives me the bias. The bias is either bullish or bearish, and that dictates the direction of the position that I'm going to be taking. Number two, it defines risk in case I am wrong, and I will be wrong. This is the disclaimer that technical analysis is not the holy grail that's going to lead you to massive amounts of profits on every single trade that you have in front of you. No, but what technical analysis does do is it defines risk and tells you where you're wrong. So the first two, it gives a bias. Do I be long? Do I be short? And the second thing is it defines my risk. Where am I wrong? Where am I wrong? And the third thing it does is it gives me a vision. The vision ahead that is less blurry because it defines targets for where we are going. And I like to call them the exits on the bullish or bearish highway. So keeping that metaphor of the driving down the road thing, technical analysis can actually give you a clearer vision ahead in that white zone where it's not even developed yet, but a clearer vision ahead as to where the targets are. And once all that is done, technical analysis can give you, the driver or the trader, a vision, a clear vision of the past, a vision of the present, and a vision for the future. The vision for the future is, admittedly a little less clear than the past. I mean, it's very easy to see all those bars in the past and where we are right now, but because the technical analysis defines your risk, either you're going to be right or you're going to be wrong. And because technical analysis also defines your targets, you're going to have a vision of, I'm going to be either right, or I'm going to be right, and I'm going to start to look toward these targets. These targets are technical levels as well down the road, and we'll get to ideas in just a second, or in a little bit here. But it also tells you where you're wrong, and if you know where you're wrong, and you know the direction that we're going in, and you know the targets that you're searching for down the road, isn't that picture clearer to you? Isn't that white area of that chart, and I use a white background, that's why I'm talking about the whites, but that area that's yet to be developed in your charts, isn't that clearer to you if you know where your risk is, where your defined risk is, and also where your targets are down the road? You now have a plan, a vision in front of you that allows you to drive safely in your trading. Drive safely with minimal risk. Avoid the accident of not being able to see the road ahead, like that rear view mirror that was just looking at the sky. You're looking out you're looking at the rear view mirror and you don't see the road ahead. That's not the way to drive. That's not the way to trade. You need to see the road ahead. You need to see the road behind. You need to see the road in front of you right now, or where the market is right now. And once you get there, once you get to that point in your technical analysis, you'll be able to look back at where we've been and where you may be going. And that's a theme of this program here, of where we've been and where we may be going. And we'll take a look at charts in just a second. Now, there's also fundamental analysis. We all know that there's a fundamental analysis, and fundamental analysis tries to predict the future, like technical analysis, from the past. So it too is, don't be misguided here. Fundamental analysis, tries to predict the future from the past, and so those people who say technical analysis tries to predict the future from the past, chart patterns. Well, fundamental analysis does the same thing. It just does it in a fundamental way as opposed to a price and chart pattern. The past in fundamental analysis is a collection of stuff that makes up what I call the story of why a currency pair is likely to move higher or lower, and that stuff can include things like central bank policy, employment or unemployment, fiscal policy, banking, weather, interest rates, stock market, inflation, retail sales, housing, commodities, trade, etc., etc., etc. All these things. I give you another vision, a vision of a big, huge cauldron there. It's a witch's brew, if you will, of all this stuff that goes into that big black cauldron. And it makes up the story of whether a currency pair is going to go to the upside or the downside. Now, I know there are certain stories that dominate, but at any one time there could be another story that comes up that changes the whole picture, that changes the whole complexion of where you think the story is. And sometimes those stories are fairly random. They come at inopportune times. Any sort of comment from a Fed official or an ECB official or a Bank of Japan official. Kuroda was speaking last night. Any of those things can derail what your thought was from a fundamental picture. So depending upon what the fundamental trader sees in the list of stuff will dictate the bias, either bullish or bearish. I think we'd all agree that everyone fundamental traders, people who just trade on the fundamentals, will look at the fundamental story and focus on what they want to focus on, and it dictates their bias. Remember, technical analysis does bias, defining risk, and targets as well. So so we know the fundamental analysis gives you a bias, and that's okay. For a technical trader, is it good to have a bias from a fundamental perspective? Absolutely. Absolutely. So it is important. So, I love fundamentals in that respect. But where fundamental analysis falls down, is those other two things. It doesn't define risk. Since when does a fundamental, or where does a fundamental story define your risk? Tell you where you're wrong. Does it tell, if you think that the dollar yen is going to go up because of a massive amount of stimulation, from one day to the next, where does it tell you that fundamental story is now changed? And so it doesn't tell you where you're wrong. It also doesn't target the exits along the way. It doesn't give you a clearer vision of what is ahead of you, where you are going. That I believe technical analysis does, and we'll talk a little bit about that when we look at the charts. So those are the two drawbacks I find in fundamental analysis, and those are big drawbacks for me. So much so that I switched myself from being a fundamental analysis years ago because I couldn't define my risk. I couldn't figure out where I was wrong with the fundamental story. I had an idea of where the market was going to go, or bias from the fundamental analysis that I did. But I never knew where I was wrong, where the story changed. It always became, it was kind of behind the curve. I didn't have any definitive thing, and that got me in trouble as a trader. It may get you in trouble as a trader as well. And the other thing it didn't do is it tell me where I was going. Where was the next level that I had to get through to and through. the exit on the highway. Imagine you're driving down the road. You get to an exit, exit 23. Where are you going next? Exit 32. If the market's going higher. That is the progression of driving down the bullish highway. And you need to have that vision of the future as well. Otherwise, what fundamental analysis does is you're looking through your side view mirror. You don't have any knowledge of what's up ahead. You just have everything that's behind you and to the side of you. And those objects in the mirror in the mirror are closer than you appear. So you're looking through the side view mirror, or you're looking through your rear view mirror, and the picture is like this. It's like I can barely see the road ahead. I don't see the deer that's coming out of the woods over here on the side. I don't have a vision of where we're going or what's ahead, and I don't see the exits along the way. And that's a problem. The best traders tend to take a little fundamental analysis and put an asterisk, and combine it with technical analysis and put two asterisks, so that vision can be clear behind you and ahead of you. And by the way, and I put it these asterisks and the fundamental analysis or the way that I balance the fundamental analysis and technical analysis is I take a look at the fundamental analysis and I say that is the secondary trading tool. That is my secondary trading tool. When I talk about a secondary trading tool, and when you talk about a secondary trading tool, you should understand that it is not the tool that you use to enter a trade. It is a tool that gives you a bias or potential bias of the directional bias for the trade. But since it doesn't define your risk, and since it doesn't define your risk, I don't want to use that as my tool for or my primary tool for buying or selling the market. Instead, I want to use a technical analysis to define that risk, or I want a technical analysis to be my primary tool that's going to get me into the trade, and that's going to give me the targets along the way, and that is what is going to be used. The technical analysis is going to be the primary tool. The fundamental analysis kind of gives you the confidence that you're going the right way. So just close your eyes and think in terms of you have a fundamental bias that's to the downside. And that fundamental bias is to the downside. Now, without looking at a chart or understanding, again, you're closing your eyes. You're seeing in your mind a chart. Now, you have a bias that the euro is going to go down because of the U.S. economy is going to be stronger than the euro economy, and as a result, the euro is going to go down. Now, you don't have that's your fundamental view, your fundamental story, if you will. And so what is going to define where you get in, however, is the technical, is that chart in your mind's eye, in the black of your vision right now as you close your eyes, and my eyes are closed, but I see a chart, and I want to find a level where I can sell against, where I can define my risk and limit my risk. A technical level, a level where I can define my risk and limit my risk, and I want to sell against that level because I have a bias to the downside, and I want to find a technical level that's going to say, sell against this level, Greg. This will limit your risk, and if the market doesn't do what it should do, then you get out. If the market moves above that risk-defining level, if the market does what I think it should do from a fundamental perspective, from a technical perspective, the price should go down. I should make a lot of money, and that's what technical analysis does. You can open your eyes now. All right, so understand that distinction between fundamental analysis and technical analysis. One is the primary tool, one is the secondary tool. The fundamental analysis is the secondary tool. The primary analysis is the technical tool. And if you do that, then you're able to see what's behind you nice and clear. You see the road behind, the mountains behind, the fields behind, and all that other stuff. And then you're also able to see a clear picture ahead. And that is what you as a trader need to do, is to understand what's ahead, where the exits are, is there anything in your way, and where are those things going to get in the way? Where are the exits going to be? Where do you have to get through, and that type of thing? And that's when you have a clearer picture. So the best traders tend to take a fundamentals clear beyond it. I already did that. All right, so let's get into the charts now, and take a look at where we've been, and where we may or should be going here. And I'm gonna try to focus on three charts here. I'm gonna take a look at the euro. I'm gonna take a look at the Aussie. I'm gonna take a look at the dollar versus yen. So let's first outline what I think are the fundamental stories or the main storylines here for the euro. Not as well off as the U.S. The EU is not as well as off as the U.S. from a GDP perspective. Let's face it. The U.S. has had some stronger growth compared to the EU, and that is expected to continue in the near future here. So overall, the fundamental story says the EU is not as well off as the U.S. The EU, however, may have stabilized, though, and weathered the storms of the Greece and the Cyprus and the Italies and the Spains. We're seeing yields down on debt instruments. That's good. They're still higher relative to other countries around the world, so they still have issues as far as still paying a little bit more for their debt for issuing their debt, and they may have less attraction from the market. But things are the market has stabilized and therefore weathered the storm, where the EU has tended to stabilize and weather the storm. Expectations are for sluggish growth going ahead and low inflation. I kind of talked about that. And the fundamental story between in the euro versus U.S. dollar is one of the main fundamental themes is austerity. That's the EU versus pedal to metal, keeping that road and driving vision in sight. The U.S. has their pedal to the metal, while the EU, I guess I should have said, they may be pushing the gas pedal to a certain extent, but they also have their left foot on the brake. So they're riding the brake, or as they drive down the road with the austerity measures in place. So it's a different dynamic going on from the fundamental perspective in the EU. Now let's talk a little bit about the technical story, and just put it in words first. We're stuck in a range, but anticipating a breakout at some point. One of the things that we as traders have to realize here is that the markets, when you're stuck in a range, there tends to be a dynamic, I believe, that eventually was going to move that market out of the range. And one of the simplest ideas that I have is that no one makes money in a non-trending market. No one makes money when the market's stuck in a range. The Eurodollar trader at the biggest banks, or fund managers, or whatever, or whatever, they're not making money trading, if you will, when the market's stuck in a range. The market may move up and down, but most of the money for them, for the big guys, the guys who need to fund their big houses and all their cars and all that other stuff, and also the guys who have a lot of zeros at the end of the count, guys and gals have a lot of zeros at the end of the count, and therefore the ones that have the potential to move the market. They're not making a lot of money when the market sits in a little bit of a range. Yeah, they make a little bit here, they make a little bit there. Someone came in the market today in the euro versus U.S. dollar and pushed the market up. You got to believe that was a players coming in who have a lot of zeros at the end of the account, and took the market by surprise, pushed the market to the upside, and boom, it was all over. But it just went up in about 15 or 20 minutes, about 100 pips straight to the upside. So that is an important thing, that they don't make money unless the market trends. So when the market's when stuck in a range, I'm always looking to anticipate a breakout, to anticipate a movement out of this range. And so if we're in a range, and that's then, what is going to be now or in the future? What's the vision for the future? And it's going to be starting to think in terms of anticipating a breakout. So let's take a look at the euro versus U.S. dollar and a visual here. Now we finally get to the chart, Greg. Yippee, we're 27 minutes into this and I haven't seen the chart. Here we go. So this is the euro versus U.S. dollar, and I'll show you exactly what I mean. 183 trading days. Now, that's 9 months, okay? Remember, we don't trade on Saturday and Sunday, so 183 days is not a half a year. It's more than a half a year. It's like 9 months. 1, 2, 3, 4, 5, 6, 7, 8, 9. 9 months time period of that we've been in in this area between these two brackets. Now, let's take a look at the upside moves here. And then let's take a look at the yellow area. I call this the lands of the yellow. Okay, we've created these two islands here. These islands are have a lot of volume going on through them here, both here and here, and quite frankly, it's quite symmetrical, isn't it? Isn't it? Yes, we've moved a little to the outside, a little bit to the outside, a little bit to the outside, a little bit to the outside this yellow area, but for the most part here, we've been in these lands of the yellow here. I love yellow for a number of days. And then, but along in this whole period, we've also had instances where the market's gotten a little excited and moved outside of the trading ranges. Some of them have been small, like 1, 2, these 3 moves. Actually, there's a little move right here to the downside as well. So there's four little movements outside of this yellow area, and one was a bigger move. One was a bigger move, and that bigger move is what we're looking for, or potentially looking for, going forward, anticipating. So let's take a look at the other data here. Only 17 closes below the 128.24 level. I just defined that level by going back and looking at these lows right here, and it came in around the 128.24 level. So we defined our low right here, and we kind of had a low here at 24, and the market moved lower, and then we used this level as a high right here, and you can see the 24 level. There's actually I've actually have 2 lines in here, 24 and 38, these 2 parallel lines, and they were developed way back here where the market was in this narrow trading range. Imagine I didn't have this data right here. I had this section marked yellow because I was looking for a breakout either to the upside or the downside at this point right here. And lo and behold, what have we done here? We've done the same thing over here. And look how the market found support and then broke below that level, and then used that 38 level on the top side, and then it had a few days here I went above and below, but then broke to the upside. And the last time in this month right here, we went a little bit below that 23 level. It looked like we're going to start a new breakout here, didn't it? And then lo and behold, the next day the market comes back up to the 23 level. We actually got down to a low 20, and here the low came right down to the 20 level again, and the market started to move to the upside. So there's something about the technical picture here, the non-trending picture here. That's pretty clear. 128.24 on the downside, and only 7 closes below the 128.24 level, or 17 closes below the 128.24 over 183 days. That's not a lot of closes below the 183 days. Now let's take a look at the high right here. Same as Sterling. That's right, Robert. If we take a look at the high here, we had 42 closes above the 131.70 level, which I defined as our top side way back when we hit this high right here. So 131.70 is only 42 closes above that level. And over these over this 183 days, therefore, 124 days over the last 103 have closes in the land of the yellow. That's 67% of the time. 2/3 of the time over this 9-month period, we've been in the yellow area. That's a lot of time. That's a lot of time spent in that yellow area. And only 35 days of the last 183 have not had the price touch the yellow area. So we may have had closes above the yellow area here, but we came into the yellow area here. And there's only 35 total days that didn't touch the yellow area. We touched the yellow area here, we touched it here, we touched it here, touched it here. We touched it here, we touched it. There's all these days right here touched the yellow area, even though the market was below that. We touched it here. These days right here, there are some days here and there's days here where the market didn't touch. So 81% of the days we've touched the yellow area over the last 183 days. That's a lot of time that we've been in this trading prison. In this area right here. And that to me suggests that we're due or getting to or about to or have the opportunity to break out to the upside or to the downside or to the upside. We're closer to the downside here, but what do we do overnight? We rally back to the upside here. The other thing, so when I look at the market, first off, I'm looking at the non-trending aspect of the market. I also, as Robert points out, this is a shoulder right here. This is a head right here, and this is another shoulder, and this line right here represents a neckline, right? That's a neckline. So if we were to break to the downside, we can anticipate a trend type move. And that's where we're closest to. And today there was a monkey wrench thrown into the thing by whoever bought the market down here. Well, let's go to the chart. Let's go to the most recent chart here. I'm going to stop sharing my screen, and I'm going to come back live to my chart here. Actually, I think I can do that from here. Share application and go to my screen here. Okay, so you see the do you see the chart up here now? Yes. Okay. Forex gal says yes. Good. So we have the chart here. We are sitting right here, and so now let's focus. So we have the big picture. Okay, we have the broad view of the picture here of the road behind us. Okay, now we have to look for the road ahead. We have to look for this white area here, and it's not filled in just yet. And we have to make our decisions on what we think may or may not happen. And we have a fundamental view, and maybe that view, I think the view is that the euro is going to have a slower growth and than the U.S. and ultimately, and the U.S. If we get the stronger growth in the U.S., we're gonna, we should see the dollar get stronger. I think, I think. But what does a technical picture tell us? And the technical picture is supposed to tell us where the risk is defined and where the risk is, and also where the targets are down the road, or the vision of the future down ahead of where we're going to go. And when you get the broader view, and now you start to look a little bit more at the closer view, what we can see here, and this is going to be all what's going to determine the bias in this pair. If I have a bias to the downside from a fundamental perspective, which I do, I still have to believe that. I still have to understand that I have the potential to be wrong, and I want to focus right here on this green line. This green line represents a 200-day moving average, and the price last week came up to that 200-day moving average on the Bernanke bar, I like to call it, and then it moved sharply to the downside. On Thursday, we came back up to that, toward that 200-day moving average, got very close to it, and came back off again. And yesterday, we were on our way to the, to the perfect place, to the break to the downside. Until today, what did we do? What did we do? Now, part of the vision, looking ahead at the road ahead, is to understand where your targets are. And when we were moving to the downside yesterday, what did we do? We went below a key Fibonacci retracement level here. This is the 50% retracement of this move to the upside. This is the 2012 low, the last swing low for the euro versus U.S. dollar, major swing. And the market moved higher off that. So I put a Fibonacci retracement, and this 50% retracement comes in at the 128.75 level. And what did the market do yesterday? We went below that 128.75 level, and the market actually closed below that level. In fact, if I look at the hourly chart, here is that 128.75 level, and look what happened in yesterday's trading. Back below two moving averages here. This is a 100 bar. Held that 100 bar. Fell below 200. Fell below the 75 level. And went lower, and couldn't move any lower off of that. There was some support down here. And what did the market do? Came back up toward that 75 level on a corrected move here. I think we got to a high of 78 here, just 3 pips above that 75.6, or 2.5 pips above that level. And the market moved down. So all things were go to the downside right here for a move below the 24 level, or the 20 level, these last two lows right here. We need to get below that level, and that was the vision ahead. That was what you as a trader have to look ahead for. You have to look for those targets. You have to get below those targets, and if you get below those targets, you look for the next target. And so forget what happened here today, but on the way to the downside that we saw yesterday, we needed to get below the 24 level. That would be the break point. That would get us out of this yellow land of the yellow prison that we've been stuck in. And then we need to see the further momentum. And where we need to go, Robert? We would need to go down to this trend line right here. Go down to the trend line right here, this head and shoulders, this neckline right here, and get through that trend line right there. And if we broke through that level, where would we go? We go to the bottom of this trend line right here. And if we broke through that level, where would we go? The 61.8% retracement, which is right in between these lows, these last lows that come down below. Last time we were down this low was in the month of November of 2012, and the 61.8 of this move to the upside would be there. Those would be the targets along the way. That's my vision going to the downside. Going to the downside. But what is most important about that vision is to get through those exits, to get through the 38 level, to get through the 20 level. And if we can't get the 24 level and the 20, and if we can't get through that level, how can we get to this point right here? We can't. And so from a fundamentals don't tell you anything about those targets. It doesn't tell you about that vision ahead. It doesn't tell you about those levels that this past tells you to predict the future going forward. What it does tell you is that we need to get to those targets before we start to take back what we took in yesterday's trade. And we took that break below the 128.75 level. We went below that level and we stayed below that level, and we needed to keep going down the highway. And it didn't. So what happened? What happened in today's trading that kind of forced that? Where did the market go? It came right up to the 75 level. This is the 75 level right here. This is a 5-minute chart here. Came right up to the 75 level, back down, off of that level. Still alive. We're still keeping the bearishness alive. And what happens as soon as we break above the 75 level up here? We break above these highs. What does the market do? Goes higher. Goes above the 100 and 200 bar moving average. Moves sharply to the upside. So what technical analysis did, that fundamental analysis couldn't do, was it told me get out at the 75 when the market moved above the 75 level. At the worst case scenario, it said get out at when the market moved above the 200-hour moving average right here. Market moved up to the 200-hour moving average, came back down, broke through that 200-hour moving average, and then continued its move to the upside right there. It was all over once the 75 level was broken, but it really became over when the market broke above the 200-hour moving average. And that's what happened this morning. When the market surged to the upside, where did the surge start? On this break of the 93 level the second time. We went above, went to 96, came back down, broke through that 93 level. Boom, Katie bar the door all the way to the upside. So fundamental analysis just gave you the vision that the euro's going down. Technical analysis, gave you the vision that something else is up that I don't know about. All right, the market moved higher and the market moved higher. So where are we going here in the euro? Where because I said what should happen going forward? I still have a bias, to the downside here in the euro. We're still not, the market's still not ready, and when the market is not ready, it's not ready, okay? But what I do know, and what I anticipate is at some point or another, we're either going to break here or we're going to break up here. I'm going to continue to use the 200-day moving averages as a resistance level on the top side, and we're going to need to see the price start to take back the 75 level on the downside. And if we're able to get below that level, then I think the process starts again to the downside. And you as a trader have to be, wary and distrusting of the market because it is distrusting. Staying in the range, failing below this break here causes a distrust. Failing above here causes distrust in the market. But we have to respect these support levels, especially after holding again here. So if the market does rotate back to the downside, we have to respect that support level. But if the market breaks to that level, look for the momentum. Look for the momentum. Look for the break of the trend line. And don't be surprised if we get something like this. This is 500 pips to the upside. We have room to roam, and 500 pips to the upside is not out of the question. We could head on down toward the 123 level. Maybe down toward the bottom of this trend line right here, which connects those lows. Okay, so that's what we see in the euro. In the euro, I take a look at all the different pairs, but I'm going to focus here on the Aussie versus US dollar. So I took my screen off here. I'm going to go back to my my PowerPoint because I'm going to talk a little bit about the Aussie versus US dollar next. Don't worry, I'm coming back. All right, let's take a look at the Aussie versus U.S. dollar, and kind of do the same thing. Let's and part of this lesson as well is for you to get an idea of how to look at the market from a fundamental and technical perspective. Fundamental story relying on China switching focus away from building to consumption. That's what China's currently doing. It's slowed down its building process. So that's the idea. If you go to China, and I was there just a few weeks ago for the first time, lots of building still going on, but it's on a relative basis, so you have to be careful. Mining boom is expected to slow in Australia as a result. If China is going to stop growing from a building and move more toward a consumption type economy, then the mining boom out of Australia is expected to slow. Mining contributed to much of the Q-on-Q change in Q1 GDP in the first quarter. Actually, it was in the fourth quarter. They haven't gotten the first quarter, I don't think, just yet. So it was in the fourth quarter. The slide is a bit off. Currency is 58% higher. The Aussie dollar, the Aussie versus U.S. dollar, 50% higher than 2008 low, and 20% higher than the 2020 low. And so the high currency has put pressure on the other sectors of the economy. When your currency is so high, 20% higher than it was in 2010, and 58% higher than it was in 2008, what does that do to your competitive nature within the international export market? It slows it down, so you have to build, you have to hope that your domestic economy continues, and you have the mining sector, and you have the other sector which is not doing as well because the currency is so high. So you have this this problem within the Aussie versus U.S. dollar. Now, one of the things that we're seeing from a fundamental perspective to support this notion that perhaps China is moving out, and this is going to have an impact on the Australian economy. And I put up a chart here, and this is the price of a steel rebar on the Shanghai Futures Exchange. This is the October contract of the steel rebar, and since February, the price has moved down from whatever 42.75 is. That's in yuan, and down to 34.74. That's an 18.75% decline in the price of steel rebar. Steel rebar, of course, goes into construction of all sorts of things, and so this is a leading indicator of that potential slowdown. If you take a look at the price of iron ore, and this is a spot price of iron ore for China imports, which, by the way, Australia imports, the biggest import to China is iron ore. And so the price of this iron ore imports has gone down from 159 down to 112.90, a 29% fall since February. So we're seeing steel rebar down, we're seeing iron ore prices of iron ore also coming down. So fundamentally, the story is saying that is exactly what is happening, and this is going to put pressure on the mining sector within Australia and should weaken the currency. That's the fundamental story. So what are we seeing from the technical side? We're seeing the market trending lower, and we're seeing the market is oversold, but who cares? The markets stay oversold for an extended period of time. So let's now go to the charts and take a look at the charts of the Aussie versus U.S. dollar, get an idea of where we stand. If we can get a clearer picture, remember the fundamental story is okay, but we see the Aussie versus U.S. dollar move higher today. Why? And we have to protect ourselves against that possibility. So let's go back to our charts. There we go. And let's go to the Aussie versus U.S. dollar. I want to take a look at the take a look at the weekly chart here and get a broader view of where we've been and what has happened here in the past in our rearview mirror here, and then we'll focus a little bit on the future. And if we take a look at the weekly chart, this broader chart here, let's just go back to this blue line right here. This is the 100-week moving average, and we broke below the 100-week moving average in this week right here, April 14th. The market did the market get back above that 100-week moving average? No, I mean we went a little bit above that 100-week moving average in this week right here, but the market couldn't close above that level, and we stayed below it. Is that bullish or bearish? That's bearish. So the technical story started to turn bearish at that point right there. Now we went below it here, and we went below it here, and we stayed above it here, and we stayed above it here. So that 100-week moving average has kind of been, over this time period, and this is a long period of time. Remember, we're looking at a weekly chart here. Over this time period right here, all these weeks right here, either we're above it or we're below it. We kind of didn't trade near, around it. We found either support against it or we found resistance against it. So the last thing that we did was find resistance against that 100-week moving average, and that is bearish. Now, in the other moves to the downside, where do we find support? At the same level, right down here, around the 101.30 level. A few pips separated those two lows, but for the most part, we had a double bottom here. We had a ceiling on the top side. For 9 months here, this is the 9-month period. This yellow box right here was a 9-month period. The market was in this very narrow trading range. What do we know about non-trending trading ranges or non-trending ranges? Eventually, they're going to break. That's what we're looking for in the euro, to break out of this thing, okay, at some point or another. Because no one makes money in this. The Australian trader's not making any money. He's going back and forth, making a little, but the money's made in this, and this move to the downside and more potentially to the downside. So what did the market do? We broke through the trend line. That was another step. And then we broke through, that same week, we broke through our low and we continued to move lower. And then we came down to the 38.2% retracement line or move, and that's where the market found support in this week right here. So we did the big break here. It came on the back of moving away from the 100. Break through the trend line. This is what you have to start to anticipate, to see ahead of you. You need to know where you're going, where those levels are. And the market broke through the 38.2, came down below below that level, and then fell below this trend line. And so happens the 200-week moving average right at that same level, fell below that level, didn't go back above that level, continued down. And today, the market finally fell below the 50% retracement and the low for 2012. That low came in at the 95.79 level in the 50% retracement of this move. This is the last major correction before the trend moved to the upside. This is a 50% of that. I'm just trying to give them the benefit of the doubt that just get me to below 50%. And it did. It went below that 95.72 level right there. And what should the market have done here today when breaking below that 95.72 level? Here it is right here, 95.72. Is that low? Yeah. 95.72. So I go to the 5-minute chart and I put up the, let me get rid of this. Oops. So if I put a horizontal line at the 95.72 level, remember that is our key 50% retracement level. And what do? We go below it and we try to find resistance against that level. At this point right here, everything is looking hunky-dory for the break to the downside. But what happens on the way to the break to the downside? The market then tries to find support. We go up to the 200-bar moving average on the 5-minute chart, back down below the 72 level, but then we come back up to the 200, back down below, and what do? We break to the upside right here. Break to the upside right here. And you can see it on the 5-minute chart, but we knew the 95.72 level was there. I knew it was there. Everyone knew it was there. The smart traders out there knew the 50% retracement at 95.72 was there. And lo and behold, the market reacted away from that level. The market moved away from that 95.72 level. And the importance of a technical analysis was that, fundamentally, everything is pointing to the downside. Well, iron ore prices went down here today. The other rebar prices went down. But what did the technical picture do? It rotated back to the upside. We got back above some key levels, including the 95.72 level, like above the 200-bar moving average. And I didn't stop the price here at the 200-bar moving average on the 5-minute chart, but intraday traders did. They stopped it there. They moved down. They tried to get back below the 100-bar moving average to keep this market moving down. What was the 100-bar moving average doing? It started to move higher. Came back up to the 200. One last look. Forget it. Boom, to the upside. And it was fast break to the upside. So that's where we sit. So now where do we go? Where do we go? And where do we go from here in the Aussie versus US dollar? Where we go from here is it comes off the hourly chart. I like to look at the 5-minute, look at the hourly, look at the daily chart. And remember, what we're looking ahead, when we look ahead through our windshield ahead of us, and we see what's behind us, and we see the 72 be lost in, we lost in the dust right here. Started to move up above the 72 level. Market moved higher. We have targets ahead, and the targets ahead become the 100-hour moving average, and also becomes this nice little trend line. 1, 2, 3, little fake move. 4, 5, got close enough here. Market traders are using that level as resistance. And where did the market stop its peak right here at the 96.74 level, right against that level, and that's going to be the next key tool or key level to get through on the top side. Where do we stand versus 100-hour moving average? We're below it right now. So right now, the bias to the downside remains. Yes, we got above the 72 level, but no, we didn't get above the trend line. Did we get above the 100-bar moving average? Yes. Could we get above the next target? No. So we're seeing the market rotate back to the downside. We're seeing this rotation back to the downside. Here's the 100-bar moving average right here. Fell below it, moved back above it, failed to get above that level, and the market sold off. Let me get rid of this. So right now the bias is a little bit more to the downside. It's keeping its bearish bias staying below the trend line right here. And we're below the 100-hour moving average, but stay below the 100, stay below this trend line, and we're going to continue to move lower here in the Aussie. You don't want to mess around with the trends. We've seen the market move above the 100-bar moving average 1, 2, 3, 4, 5 different times now, and each of the time the market has gone above it, it's failed. So the market's given the benefit of the doubt of the trend line, given the benefit of the doubt of the failures up here. If the market is going to go higher, guess what? We have to get above this level right here. So the technical picture still remains a little bit weaker here for the Aussie versus US dollar. And is there room to go lower? I go back to the weekly chart and I take a look at this, and this is only the 50% of this move to the upside of the move up from 2010, which has seen the Aussie dollar depreciate by 20% of this move to the upside. If we go back to here, 2008, we haven't gotten to the 38.2% retracement of this move to the upside. So going forward, folks, stay below this trend line, stay below the 100-bar moving average, and start to look for a move back down through the 72 level and stay below that level. If you stay below that level, next target becomes here, which is this high right here and this low right here. Key support level right there, and the 38.2 at 91.40. There we go. It doesn't matter whether you agree with me or not. And quite frankly, I can be wrong all the time. This Aussie dollar may surge up and we can head up to 102 or whatever. But I'll know right here, Robert. I'll know because the technical picture is there. The fundamental picture just gives me a story now to tell. The technical picture is going to tell me a story, the story that I really want to listen to. And so that's the importance of it. And as long as I trade near these levels, my risk is going to be defined and limited. And I may be wrong because I think the market's going down here and it moves back above the 72 level and I have a loss on my trading book, or you do as well, or other traders do as well. But, hey, doesn't matter. By the way, the RSI has been below the 30 level here since par 10, so be careful using the RSI. All right, the final currency pair I want to take a look at really quickly before I finish up here is the dollar versus yen. The dollar versus yen has been trending to the upside. We moved above the 50% retracement of this move down from the 2007 high. That level comes in at the 99.84, and the market moved right up to that 99.84 level. Actually got to a high of about 93 right here. Came off, broke through that level. People thought it was the par level or whatever, and it was. The traders were selling against the par level, but it also was a 50% retracement of this entire move to the downside. So that was a technical picture that I was looking at. The market broke through that level and moved to the upside. It surged up to previous lows right here and started to come back down here. Off the daily chart, this is the picture that I'm focusing on now right here. Or the fundamental story is obviously lots of um, stimulus coming out of Japan that has forced the market to the upside. But what have we seen just recently in the news is that Kuroda's being a little bit saying that market stability is also important. Market stability is also important. We have a lot of different views coming out. The economic minister talked last week, and the market moved. A advisor to Abe talked, and the market moved up yesterday. And Kuroda, the main guy, spoke here overnight. And we also saw minutes of the Bank of Japan recently, and those minutes suggested that there's some dissension among the board, that bond yields do, in fact, matter. Bond yields have surged higher of late, and so has the stock market, as a result of the move to the upside. Maybe it's gone too far, too fast, and 2% inflation target also means that bond yields could go up to 2% or above. They're at 1% right now, so quite high, but there's room for that type of move, and so that could cause some problems here in the dollar versus yen, the move to the upside here in the dollar versus yen. We are seeing from a technical perspective here this trend line right here, which is looks like it's coming under a little pressure right now, 101.14. Below that level right now is we're currently at the 91. We're breaking through this trend line. This trend line has 1, 2, 3, 4, 5 different points on it. We're breaking through it here. If we get a close below that level, the technical picture is going to get a little bit more muddy for the dollar versus yen, looking lower, consolidated / lower. That's what the story is telling me. That's what the technical picture is telling me. That's what I'm seeing here in the off the daily chart in the dollar versus yen. Weekly chart. Where are we going? What was once a key resistance at the 99.84 level becomes key support on the downside. If the market's able to stay below this trend line and start to move down toward that 99.84 type level, look for support against that level. Also down here against this broken trend line here of this bull flag here, a little bull flag here and trend line, little trend line coming across. Both of those things sort of converge the same area, a little bit below that level around the 99.28. Those are all possibilities. This is just the 38.2% retracement of this move to the upside also comes at that level. So that would be the target on the downside if the technical picture remains below this trend line. And right now, it's looking like it's under a little pressure. I had to hurry up there because I'm at my 11 o'clock hour. But I hope that through this comments here that we that I've seen here today, you got a better vision, better vision of what you're trying to do in your trading. It's good to have a fundamental bias. Make sure that fundamental bias becomes your secondary trading tool, because today amongst all the days, took my fundamental bias and turned it upside down. It turned it upside down to the point where the market rallied or went against what my fundamental bias was in a lot of things like the Aussie dollar and things like the euro versus US dollar, and turned it to the upside. It was only because I had that vision from the technicals, from the clues that I get from the technicals, that told me what I should be doing in the market. Fundamentals gave me a vision of what was behind me. And so did technicals as well. They gave me a vision of what was behind me. But what's most important for you as a trader is to see what's ahead of you, to be able to see the road ahead, to see the road clearly, and to be able to get out when you're supposed to get out and get in when you're supposed to get in. And if the market does what you think it should do, you're going to do okay as a trader. My name is Greg Michalowski. I want to thank you all and thank the people at FX Street for providing this opportunity for me to be here with you. I hope you learned from it. If you want to listen to me more, you can come to my daily livestream.com/FXDD. Otherwise, I will also be back next month with another one of these webinars here that give you a little education about how you can approach the market and how you can trade it. They will be recorded and it'll be in the archives. Thank you very much again for the people at FX Street. Bye-bye now.